Welcome guys to another video on this channel. Today we will talk about the topic if the stock market is overvalued, and I will not show you any statistics of the real economy data versus the stock market price, where we don't even know who made these statistics or how the statistics are calculated. Instead of showing you these statistics, I will show you my results based on my own indicators that are self-developed and where I know how it's calculated. So let's head over to the first indicator, which I already showed in the last video, and this indicator is the supply chart, which you are seeing right now. And the green line that you are seeing right here is the supply, and the blue line is the price. You already can see that the supply right now is very low. It even has decreased since my last video, and this is a strong warning signal that a correction is right in front of us. If you want more details, then I will link my last video right here. You can check that out. In that video I will go a little bit more in detail on that topic. But just a comparison, you can see that here in February the supply chart was also very low, almost the same level as it is right now. And then and you also can see it right here, what then happens with the price of the stock market. It dropped massively. Now you know that this indicates that the stock market right now is heavily overvalued, but there is another factor that we have to include in our analysis, and that is the Fed, the Federal Reserve System. I also mentioned this in a couple of my last videos, but today I want to explain this a little bit more in detail so you can understand how the Fed is working and how their system is working. To do that, I will go into Paint. By the way, this program is so underrated, it's ridiculous. Every time I want to explain something in detail, Paint is the best program to do this. But I go a little bit off topic here, so let's get into the explanation. First, I will draw the x-axis and the y-axis. The x-axis represents the time window, and the y-axis is representing the money printing. So that's why I'm writing here MP. And normally there is always a little noise. So like the line here, sometimes a little more, sometimes a little less, but there is always a little. That is the same as in the real world too. Even if you are on a perfectly quiet place and it seems like there are no noises, but measured in decibels there are noises. Only in the space it is perfectly quiet, but this is another topic. What I want to say is that the same thing is happening in the money printing. A little noise that is always there that you didn't realize. But now there are critical times when the normal money printing wouldn't be enough to keep the market stable. And when the Fed is seeing that there is danger, uncertainty, or something else they don't like, then they are starting to take action, money printing action, and that looks like this. You have the normal money printing, so the normal noise of the market, and then something is happening and the Fed is starting to expand their money printing actions. They are printing more and more money, for example, here, 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 and here. And when they are seeing that their actions are showing the effects that they are wanting, the curve is slowly flattening till it is back at the normal level. But as I said, the curve is flattening, so it is not like, alright, it looks like our actions are affecting the market now, we are stopping the printing and going back to normal levels. That is not what it's like. The curve is flattening, but there are still printing money, let's say here and here, here and here. It is just less and less every time. Now the thing is that the money is not directly injected into the stock market. This is happening over time. So when you are seeing that the point is reached, that they are slowing down their actions, then it's probable that the markets are rising again. And just to show you this in detail, I have the current numbers copied out of our program. Here you can see the date, and the percentage shows the expansion of the money supply per week. You can now see that right now they are still taking action in money printing, and since the last weeks the numbers are increasing. So we are in this cycle of my wonderful paint picture. We don't know on which point exactly, but we know that we are still in the upward trend. So now we have the scenario that there is an extreme shortage of supply that indicates a correction, or maybe even a big correction. And on the other side, there is the Fed that is playing against it. Also, there are other warning indicators. For example, the volatility index in the weekly chart seems to turn around in the floating moving average, and when the price in the volatility index is rising, that is a sign of uncertainty and eventual price corrections in the stock market. You also could see that the indices are showing weakness. I exclude the Nasdaq here because, as I said in my last video, the Nasdaq is very strong because all the big tech companies that are performing extremely well at the time are in this index, but the other indices are showing some weakness. And another reason I also mentioned in my last video is that the cap drivers are joining the party. In my last video, I told you that I saw a statistic that is showing the new stock market accounts, but I didn't know where I saw it. But I did some research again, and gladly I found it. Here it is. In this statistic, you can see the average numbers of account holdings, S&P 500 stocks. And as you can see, it is rising strongly, and that is as well not a good sign. I will link the website to this picture down in the video description. Now we have a lot of information, and I think we need a summary, a final summary, and this final summary is that very much is indicating that another big correction is right behind the next corner, but the Fed is slowing down the wheels of the car that we are sitting in. So the risk has massively increased, and that is why I'm always looking for a short entry and don't open new long positions, or just open new long positions with close to 0% risk that are not open for a long time, especially not over the weekend. That doesn't have to mean that tomorrow the next crash is coming. That just means we have to be patient, we have to be realistic, and most important, we should not let us drive by our emotions. But this is one of the most important rules in trading overall, not just yet, but yet it is even more risky to ignore that rule. Now we have to wait and see what the Fed will do to make further predictions. Of course, I will give you updates here on my YouTube channel or on my Telegram channel, so make sure you subscribe to both of them if you don't want to miss the informations. And the link to the Telegram channel is down in the video description. If this video helped, then a like would also help me. And if you have any questions about this topic, or if you have another opinion then write it down in the comments. I read all the comments and I would love to hear your opinion on that. Have a great day and I will see you in the next video.